It's great to be here talking on a very interesting and important topic. And what I'm going to talk about today is try to give you guys a real bird's eye view of the national mortgage market leading up to the financial crisis and recovering from the Great Recession. And I think Miriam's going to follow and sort of compare and contrast the specifics of how the market. Oh, is volume's an issue? Let's see. Let's see. Is that tightening it? Or is that making it worse? All right, how is this better? I can lean forward. Okay, all right, I can hear myself over the thing. Okay, sorry, so briefly reiterate, I'm going to be discussing some national level trends in the mortgage market to kind of compare and contrast with how things might be similar, might be different in Indian country, and some special topics that are particular interest and some particular challenges we've been seeing at the national level. All right, so before I begin, of course, I have to give the standard disclaimer, which is that, anything I'm saying here is solely my opinion and not the opinion of the Board of Governors or the research staff. Okay, so to kick off, this is something that I'll be pretty familiar. This is just a chart of the total volume of home purchase lending over the last 20-odd years. And we can see, the familiar, oh, here we go. It was off. Okay. There we go. The rise in total lending from through the mortgage bubble right into the burst and the subsequent collapse. We can see there's certainly been a recovery in mortgage lending, but even as of 2014, the total number of home purchase loans hadn't recovered to the level we were seeing as far back as 1994. So while there's definitely been some recovery in this market, we're still lagging behind what we might have anticipated, even going back 20 years. And similar here, we're looking at house price growth. House prices have kept along a more sort of upward trajectory. You can clearly see the effects of the recession, though this acceleration beforehand is probably, or was certainly unsustainable. But at this point, where home prices are above even the level they were at the peak of the housing bubble, but these are not corrected for inflation in any way. And some more good news is that the delinquency rate and foreclosure rate on mortgage loans is starting to go down. That banks are getting these bad loans off their books. The newer vintage loans are not defaulting at nearly the rate of the old loans. So in general, the total risk level in mortgage debt is cleaning up. So that kind of gives you a sense of what the very broad path of the mortgage market has looked like recently. Now I want to dive into how easy it is for a consumer to get credit, because we've been hearing that in the run-up in the bubble, credit was very loose. Anybody with a pulse could come in and get a loan, and now it's become very, very difficult. So let's try to put some numbers to that. And the first thing we're going to look at is this the Mortgage Credit Availability Index that's put out by the Mortgage Bankers Association. And this is an index that's a combination of a bunch of numbers based on the creditworthiness of the borrowers, some of the loan features, and some of the vehicles that these loans get sold into. And the MBA's perspective on this is that credit was getting extremely available between 04 and 06. Unsurprisingly, you can clearly see the bubble there. It's obviously tightened quite a bit, and then we had a long flat period where we didn't see much easing of standards. Though in the last couple of years there might be some slight relaxation, but we're again nowhere near where we were in the early 2000s. Another thing you might want to look at when trying to figure out how available credit is for a typical borrower is to go and ask the loan officers who are making the decisions. So every quarter the Fed runs the Senior Loan Officer Opinion Survey, and what I'm showing you here is a chart which is the net fraction of senior loan officers at the major mortgage banks which claim they were tightening credit versus claim that they were loosening credit in the past quarter. So when this line goes above zero, credit is tightening. When the line goes below zero, credit is easing. And as we get in more recent years, we've disaggregated the data into different types of loans, whether that be jumbo loans, GSE eligible loans. And again, you can clearly see there was a massive tightening right when the recession hit. That obviously banks were tightening their standards. And there's some evidence that we're now in a world where it's a little bit easier to get credit. Every quarter, you can see that, to take an example, let's look at the GSE loans. These are loans that are eligible to be sold to Fannie Mae and Freddie Mac, which are a huge fraction of the market right now. So this is the blue bar, and over the last 7 quarters, every quarter, more loan officers have said we've relaxed standards on these kinds of loans than have tightened standards. The one exception to this, of course, is that if we look at subprime lending, which is the purple line here, or these yellow bars here, it doesn't really look like there's a lot of willingness to continue lending to subprime borrowers, which the definition of subprime is a little fuzzy, but we generally think of it as someone with a FICO score of 620 or less. Another way of looking at this is if you just take all the home purchase loans that have gotten originated throughout in a given year, and look at the distribution of the credit scores that those individual borrowers got. And this is data from Equifax, a credit bureau, and I'm showing you the 10th percentile, which means 90% of new borrowers had a credit score better than this level, and 10% had a credit score below this level. We can see that, going back in 2005, 2006, there's a fair amount of lending to people with a score of 600 or below. Whereas, this is the tightening that we've been seeing in all the other charts. And now if you have a score much below 640, there's very little lending happening to that segment of the market. And there's not a whole lot of evidence that this has relaxed recently. You can make a big deal out of this slight dip, but if there's been any relaxation, it's pretty minor relative to the tightening that happened through the recession. Looking a little deeper into the credit score data, you can see that there's some extra action happening 600 to 620, but it's pretty minor relative to the overall size of the market. If you are if you're a first-time home buyer looking to get a mortgage, if you don't have much money for a down payment, or if you have damaged credit, there are some options, and these are generally through some form of government program or other. By far the largest of these is FHA lending. This is very popular for first-time home buyers, that you can show up with only 3.5% down and get a mortgage loan. You technically can receive FHA insurance on the loan with a FICO score of 580, though it's almost universal that lenders have imposed overlays above that. So again, to the last graph I showed you, if your score is much below 640 or 620, it's going to be much more difficult to get such a loan. And speaking of the popularity of this, through the early years of the financial crisis, nearly somewhere between 40 and 50% of all home purchase lending happened through with FHA insurance. Over the last couple of years, we've been in about 25% of the market has FHA insurance. Then I should also have Freddie Mac's Home Possible program up here, but it's very similar to the Fannie Mae program, the Home Ready, where these are starting to roll out in 2015. Borrowers, you can get a conventional conforming loan with only 3% down, and a debt to income rate, total debt service payments to income ratio of up to 50%. Though there are some restrictions on the borrower, the neighborhood has to be low income, and there certainly are there's going to be some tighter underwriting than you might have gotten with other insurance programs. And then for borrowers who can qualify, if you've served in the U.S. military, you're eligible for a VA loan, which you can get with zero money down, though there is a credit check. And the Rural Housing Service loans. Rural Housing Service also does some direct lending, again for borrowers with little cash on hand, but with some credit checks. We kind of talked about the supply side, so let's look at what other factors that might be hampering or driving the mortgage market are the demand side. Volume again. So looking at from the borrower's perspective, we know that the homeownership rate was climbing steadily through the 90s and early 2000s. It hit a peak at the bubble and started to fall. And what's a little worrying is that it doesn't look like this slide has stopped. That we're back. We went from a peak of close to 70% of households own their home to now we're down below 64%. So we're below the levels we were seeing in the early 90s, and the trajectory hasn't really looked like it's turned around. So it's sort of a question of, are we in a new world where people are just comfortable renting for a much longer period of their life? We know that household formation is much slower. Young people are living with their parents for much longer. So possibly some of this is holding back entry to the homeownership, and of course, some people who were homeowners lost their homes through foreclosure and are had to move into a rental space. So I want to focus for a second on the young homeowners, because these are the people that we hope would be the inflows into the market, the new first-time home buyers. And what we can see is that the decline among this group was even more severe than in the total population. That overall there was about a decrease of about 5 percentage points in the homeownership rate, but among people ages 24 to 32. This decline was 9 percentage points, so it's larger in absolute terms, and of course because the homeownership rate is lower among the young. In relative terms, this is even greater. And in terms of trying to understand what's holding back homeownership for the younger generation, a couple explanations have come up, because when you conduct surveys, and NAR and Rutgers and others have conducted surveys of young people and asked them, do you want to own your home? And it's still very common that the young people aspire to be homeowners. We ask them directly, but they're being held back, and a very common response is that student loan debt is a significant anchor or hampering people from getting a mortgage. As a nation, we owe over $1 trillion in student loan debt, and this can severely hamper people's debt-to-income ratios. If you default on your student loan, that's going to wreck your credit and make it much more difficult to get a loan. And similarly, these young people were entering the labor force at a time when the labor market was really poor. The unemployment was high, wages were low, and there's been some research indicating that people that enter the labor force at a time when the labor market's bad sort of carry the scars of that recession throughout their career. That sort of a bad shock on your first job affects the next job you can get, the next job you can get. It can take a while to really recover the income you might have gotten had you not had that bad early labor market experience. So this is similar to what I showed you before. So another question that gets asked in the Senior Loan Officer Opinion Survey is, have you seen an increase in demand or a decrease in demand over the last quarter? And this demand for mortgages is a bit more seasonal, in the sense that we know that in the second and third quarter of the year there's a lot more activity. But still you can see that, unsurprisingly, through the recession there was a major loss in interest in lending. Though in the last couple quarters, it looks like maybe on net there's some slight increase, though it's certainly, it's not an overwhelming increase in demand for mortgages. But maybe some reason for optimism. And I mentioned before that the labor market can certainly hamper the demand for mortgages. If you don't have a job, it's going to be much more difficult to go ahead and get a house or to want to incur that much debt. And we can see that the unemployment rate, which spiked, has been slowly and steadily declining there's been some concerns that maybe the unemployment rate isn't really reflecting the true nature of the labor market as people maybe exited the labor force due to the lack of demand for their services, or people are underemployed and not earning the wage that maybe they could have in better times. And you certainly can see that the labor force participation rate has continued a long and slow decline, though the employment to population ratio has finally started to tick up a little bit, which is somewhat encouraging. And I think just yesterday, the Census Bureau announced that in 2015, median household income increased by over 5%, which is the greatest single year increase in median household income that they've seen since the 1960s. So maybe we're finally getting back on track in the labor market, which may spill over into the housing market. All right, so I want to talk a little bit about the different experience that borrowers may have based on some of their demographic characteristics. And one of the interesting and somewhat concerning patterns that we saw in mortgage lending since the crisis was that really the gains in lending to minority borrowers that we'd seen through the early 2000s were completely reversed. That not the Hispanic, white, and the black borrower share of home purchase loans fell very significantly between 2006 and the subsequent years, and really hasn't recovered much at all. This data is from the Home Mortgage Disclosure Act, and these missing data points in 2004 because of a change in definitions of ethnicity. So the data from that year is a little bit junky. But basically you can see the pattern that some increasing minority share and then a quick decline. And if you looked at Native American, Alaskan Native, and Native Hawaiian, you'd see something very similar. And so in trying to understand what's happening here, we've turned again to the credit bureau records to look at which segments of this population are still getting credit and which ones are having trouble. And so if we look at black borrowers, we've got these by color. We're looking at 2000, 2006, and 2014. I'm graphing the total share of home purchase loans that go to each of these categories, divided up into buckets by credit score. And we can see that above 620, there's really no loss of market share among black borrowers. That it looks like you're facing a similar ability to get a loan as long as your score is in the prime or the near prime category. But below 620, there's a huge loss in market share. So those, like I showed you before, with that increase of the 10th percentile in credit score. If you have a low score or a missing credit score, it's all of a sudden there's far fewer loans going to this market segment. And if we turn to Hispanic white borrowers, you see something very similar, that there are some small declines for borrowers with a score above 620, but once you get below 620, there's a massive loss in market share. And then finally turning to white borrowers, you actually do see a similar pattern. So it looks like it's essentially across all races and ethnicities, the share below 620 has dropped and the share above 620 has remained fairly flat. The big difference here, of course, is the total volume of borrowers above 620 that are white is much greater than the volume of borrowers that are black or Hispanic above 620. So really what this means is that there's been this general tightening of lending standards, especially along the formal credit score margin, has really disproportionately affected minority borrowers, because there's a larger fraction of potential borrowers with these lower credit scores that have been locked out of the market. So turning now to where people can get their loans, what I'm showing you here is a breakdown of market share by the type of institution that's originating the loan. This is again from Home Mortgage Disclosure Act data. And so we can see that a couple major changes happened around the time of the Great Recession. One of which is that affiliate lenders, these are non-bank lenders that are owned wholly or owned by a bank holding, owned wholly by a bank or owned by a bank holding company. They used to be a really significant player, have kind of been squeezed out. the large banks were increasing their share through the housing boom. And while there was a quick collapse of a bunch of independent mortgage companies with the bust, banks have started to lose those large banks have started to lose their share rather rapidly towards these independent mortgage companies. And here, large banks I'm defining as any bank or thrift with over $1 billion in assets. Independent mortgage companies are institutions like Quicken that don't take deposits, but will take a warehouse line of credit and then do all their business through lending to consumers and selling the loans. So really we can see that there's been this retreat of the larger banks from the mortgage market to the point where now, and I can tell you this trend has continued, though unfortunately we haven't released the 2015 HMDA data yet. And so really the mortgage market is being increasingly run through these independent mortgage companies. Though on the other hand, it's a smaller share, but it's an interesting and steady trend that both credit unions and small banks. So these small banks are guys with less than $1 billion in assets, so we can think of these as more the community bank level, have been slowly and steadily increasing their share pretty much since 2006. They're not major players yet, but more and more people are going to this type of lender. So if people are going to a community bank to get their loans, then it's going to be very helpful if they actually have a branch nearby where they can go in and talk to a loan officer. And one possibly troubling feature of the banking market since the crisis is this retraction of the total number of banks that they were getting built. Branches were getting built rather rapidly. So we're looking at branches, not the not total number of institutions. So mergers shouldn't really matter here. And we've seen that there was a rapid increase and then kind of a retreat. And maybe the total number doesn't matter so much, but what we're really concerned about is the ability of someone to get to a local branch. And so the question is, how many people don't have a local branch to go to? So if we look at zip codes, and we divide up zip codes by median family income, less than $40,000, $40,000 to $80,000, or greater than $80,000. What I'm showing here is the fraction of these zip codes that have 0 bank branches located in them. And we can see that if the area has greater than $40,000 median family income, there's a lot of banks around. The fraction of such zip codes that don't have a branch is very low, and it's been rather flat. Unfortunately, with the lower income zip codes, this is a much higher fraction without a branch, and it's been increasing since the crisis. So more and more people in lower income communities don't have a local bank branch that they can walk to. So an important aspect of mortgage financing is figuring out what to do with a loan once it's been originated. That I mentioned, the independent mortgage companies are taking over a large fraction of the market. They don't hold these banks in portfolio. Their whole business model is around getting a line of credit, originating the loan, selling it off, and using and then continuing the cycle. So if we look at where these loans end up getting sold, the gray is the GSE securitization. These are being sold to Fannie or Freddie. This has always been a major source of securitization for loans. But the blue is private label securitization. We can see that when the crisis hit, this market essentially disappeared. That if a loan is going to be securitized now, it's going to happen through a government agency, or it's going to be held on some bank's portfolio. There's really no market for private MBS anymore. And between FHA and VA securitization, the GSEs, the government in some form is responsible for really the bulk of securitization of loans. And another thing we've seen with, as I mentioned, the big banks have been sort of retreating somewhat from the mortgage market, or being crowded out by the independent mortgage companies. And one thing that's also happened is that there's been a reduced appetite for servicing rights, that possibly due to the new Basel III rules about how these servicing rights are risk weighted, and looking at their assets, the big banks, essentially don't want to. They used to buy these loans from the independent mortgage companies, sell the loans to the GSEs, and hang on to the servicing rights. Now if they don't want the servicing rights anymore, they're not going to buy the loans. So we've seen an increase of independent mortgage companies selling the loans directly to the GSEs. And you also see a similar pattern with the Ginnie Mae securities, which are the FHA loans. And you can see that sort of through the housing bubble, the independent mortgage companies were selling only 10 or 20% of their loans directly, whereas now we've spiked to a majority of such loans, especially in the refinance space. We're getting close to all the loans that originate are being sold directly rather than sold on to a commercial bank, which would then chop them up and keep the servicing rights. All right, now the topic near and dear to my heart is regulation. So I'm going to discuss a couple different pieces of regulation and ways in which the market has reacted to them that sort of highlight disparate points. So the first one I'm going to talk about is the ability to repay in qualified mortgage rules. And so these were established by the Consumer Financial Protection Bureau. And the idea here is essentially to put a check on predatory lending. That the CFPB told lenders that you need to make a good faith determination that the borrower can actually repay this loan. Since the lenders were a little concerned that the wording was kind of vague, they established a qualified mortgage category, which puts some sharp boundaries on a loan that essentially the CFPB promises, if you fit in this box, then you're free from litigation based on breaking the ATR rules. And these so some of the restrictions put in place on QM were potentially restrictive. The one that got a lot of press was the 43% debt to income ratio, and which is the debt service to income ratio. And the reason this could be a problem because there's quite a lot of lending that happens with greater than 43%. And so especially if you're worried about marginal borrowers, people with sort of risky characteristics, the concern was that QM really might have killed lending to that subpopulation of borrowers. And really the saving grace came in with the so-called GSE patch, which says that any loan that's eligible to be sold to a GSE or for FHA insurance is exempt from this 43% DTI cap. So if you look at the total lending, there really wasn't much of a dip. The imposition of the QM rules didn't change much. However, there's some concern that this DTI cap really is necessary to keep in place. We're going to see some very strong overall effects in the market. If you look just at jumbo loans that are above the conforming loan limit can't be sold to the GSEs. What I'm plotting here is just the total number of loans in 2013 before QM went into effect, and 2014 right after. You can see among conforming loans, this 43% doesn't do anything. It's the distribution is just smooth through there. But if you turn to non-conforming loans, these are the jumbo loans. In 2000, there's many fewer of these loans. So this is not having a huge effect on the overall market. But it really looks like this QM has essentially killed the greater than 43% DTI jumbo loan market. And so as far as keeping the GSE cap in place, it seems important that lenders really are responding to QM and would like to keep their lending within that box. Another important piece of legislation is the Community Reinvestment Act, which is certainly not new. But what the Community Reinvestment Act does is motivates or instructs banks to make certain that they are providing credit to the entirety of their community, which means that you can't redline around low-income neighborhoods and not do any lending there, essentially. What's interesting about the CRA with recent trends in lending is that, of course, the CRA only banks and thrifts, depository institutions are subject to it. So as we've seen that there's this increase in independent mortgage companies, as a fraction of total lending. Fewer and fewer loans are originated under the auspices of the CRA. And similarly, the way CRA examinations tend to take place, rural areas get a much more cursory examination. So it's really only the bank lending within metropolitan statistical areas does the CRA sort of keep an eye on the lenders and make sure that they're doing their diligence in terms of getting lending to their total community. And one way we can see how this is affecting, or one way we can see how the CRA might be gaining or losing effectiveness across the years is this is the total lending by banks that happens within their assessment areas. So those assessment areas are essentially the counties within which they operate a branch. We can see that the small banks have, again at under $1 billion, have shown kind of a long and steady decline in the fraction of their lending that happens in a county within which they have a branch. The large banks have shown sort of a much funkier pattern where they're through the housing boom, they were getting very excited about doing a lot of lending all over the country, and then with the bust, they quickly retracted and restricted their lending to areas where they may have some more soft information and a local branch present. Though again, we've seen since the recession kind of a decline in the lending that they're doing within the assessment area. I think this is the last point I want to make. That so I mentioned that FHA lending is very important for first-time home buyers, for people without 20% to put down on a home and with poor credit scores. And another thing that the large banks are doing is that they are rapidly exiting the FHA market. This is potentially in response to some false claims acts litigation by the Department of Justice, where they've leveraged really large fines against banks for their record of FHA lending. And we can see that, well, for about from '95 to 2011, banks rather consistently accounted for greater than 50% of all FHA lending. And just in the last couple of years, this has really fallen off a cliff. And now we're at or below 30% of all lending. So the banks and the large banks in particular are really getting out of this market. And that's my time, so thanks very much.
My name is Miriam Jorgensen. I'm Director of Research for Native Nations Institute, which is part of the Udall Center for Studies in Public Policy at the University of Arizona. I also have been a Research Director of Harvard Project on American Indian Economic Development. I just wanted to say thank you to the Salt River Pima Maricopa Indian community. It's great to be on your lands today. It is exciting to be here in such a beautiful facility. And I just wanted to pay my respects to their elected leadership, their other respected leaders, and to their elders past and present. I just think that they're all with us in the room today. I also wanted to just point out that I just thought that President Ray's comments about hospitality being a real characteristic of the tribe here must be really true, because this is some of the best food I've eaten in Indian country. I love that breakfast. So now you can tell where my concentration is. The program bills me as providing an Indian country view of what's gone on post-recession. I think, like Dan, what I'm really going to be able to do is provide you a little bit more of a data spectrum that shows you some of the kinds of things that we know that have been going on in Indian country pre, during, and post-recession on a couple of different fronts. I don't want to take up very much of your time, but wanted to respond to just a couple of the kinds of things that we saw in Dan's slides that are part of the story of Indian country that is more complex, I think, than some of the big picture overviews. And some of the questions already are pointing to, well, what's different about Indian country? What's going on in Native communities? What do the Native data look like? As Jackie pointed out, we don't always know all of that Indian data. And as the point was made over here as well, sometimes the scores aren't collected or particular data series aren't collected. But I'm going to give you some of the things that we do know. So I wanted to start off with this. And this is not an unfamiliar story to the folks in the room here. And it's frequently the story that we hear about mortgage lending in Indian country. And the story goes something like this, that Indian country is incredibly poor. And it's much poorer than other parts of the nation. And we really shouldn't expect a lot of mortgage lending in places where people are poor. More than that, of course, we know that there are severe housing problems in Indian country, so it would be, and those housing problems tend to be more severe than other areas, so it would be, of course, nice that if those things kind of got solved first, potentially through low-income housing programs that weren't mortgage-focused, were instead rental kinds of programs. And of course, that American Indians living on reservations have poor or non-existent credit. So how could we ever really expect that there would be mortgage lending in Indian country if there isn't credit for the people who would be potential borrowers? And more than that, if Indian people get loans, there's an ethic that says, well, housing should be provided, so why should I repay a loan? We hear that sort of story about Indian country too. And then we hear the story that lending on trust land is incredibly difficult to impossible, especially given collateralization concerns of trust land. And you'll notice that I've put this in quotation marks, that this is the story. But I think it's important to know that the story's not always true. And I think it's really an important way to pick apart the data and really interrogate it and say, why is this what gets said when there's actually underlying strands that are very different? So I want to present to you some of those things. And again, many of you gathered here together all know this. Some of you have been key in collecting these data, creating the policies and the trends. But it's about constructing that argument so we can move, in a sense, past this story into addressing the real work of the convening, which is how do we address those really serious problems and challenges that this stuff is kind of a distraction for. So the first point I want to make is this story about Indian country being poor. Well, absolutely it's poor. But I think the really critical thing to notice is that the 20-year trend in Indian country up through to during the recession is that Indian country was growing when the rest of the United States wasn't. That's really important to take on board. So if you look at these data, we had a lot of growth during the go-go 90s. That was really when self-determination in Indian country was taking effect. You heard those incredible stories from Jackie, who was telling you about how much change was taking place overall in Indian country and specifically around housing issues too, which were part of that driver of change. Even when the rest of the country in the recession, so up through that period that captures the recession in the American Community Survey data, many of you know that the way we measure data changed in the census, so that's why there's that funny column, 26 to 10. The rest of the country were starting to see drop-offs in income, and you could hear that in Dan's presentation too, when he was pointing out that we've only very recently had that recovery in income that's really just coming out in the income statistics now. But look what was going on in Indian country. On average, it was still going up. Now, some of your sharp eyes will notice that says reservations other than Navajo. That's because Navajo is so big, obviously, that if we included it in the data, it would kind of swamp and change the numbers. But for those of you who are interested, and we are in the Southwest, I want to make sure to point out that you know what's going on in Navajo. And in fact, it's the same pattern, that there is growth going on there as well. And so Indian country is poor, but there's growth going on, and these are average numbers. What's per capita income? It's the total income in the community divided by the total population. And so that's not just working adults, that's everybody in the community. So that is growing, and it's growing faster than the rest of the United States, and in ways that, and at times when the rest of the United States wasn't growing. And those of you who have sharp eyes were wondering what's going on in Oklahoma. So here, this is the mass of it all. This includes Oklahoma, this includes Navajo, doesn't include Alaska Natives though, so this is just lower 48, but we still see that growth. And wanted to look at some of the other figures that you feel it's not just that income growth, that there's increasing employment in Indian country. So you're seeing these falling unemployment rates, even when the unemployment rate in the United States was going up. And we're seeing changing labor force participation in Indian country, again through the recession, even in the period when the United States as a whole is not experiencing good things, Indian country is still growing well. This is female labor force participation, steady rises for women. So many of you will not be surprised by this statistic though. The kinds of labor force participation issues that many men experienced in the mainstream in the 2000s during the recession, Indian country had already gone through. They experienced some of that in the 90s during that go-go growth period, when the kinds of jobs that had been available for men were a little less available, but women were entering the workforce in Indian country in big degrees. But see what happens to men in the 2000s? It actually starts to turn around. So you get this rising labor force participation. These things are critical, because as mortgage lending is predicated on how well a family or an individual is doing economically, we're starting to see some spread in Indian country. We're starting to see the growth and development of essentially a middle class. So it's no longer this notion of Indian country's all poor. These per capita figures are masking the fact that these are averages, and we're starting to see the development of truly middle class families in Indian country who are capable, financially at least, of mustering a mortgage. So, and this, I just love to show this slide too, because it shows those more rapid growth rates in Indian country of what's going on with income. Sure, it's going to take some time at present growth rates for incomes to converge to the mainstream, but the growth is more rapid and it's been reasonably steady over the last 25 years. So what's the end sum on that? I've kind of made these points already, but there's a growing middle class, and by growing, I just want to keep stressing that's the IE, that means it's getting bigger, so there are more potential borrowers out there. There's a growing number of single identifier American Indians living in counties just off the reservation. What does that mean? I'm barely allowed to talk about this because this is data that's coming out in the new Urban Institute study that they're doing with HUD. But this is, the study's out to tribes right now for review. So if you want to look at that study, approach your tribal chairman and you can look at it for the early release to tribes and for comment. But I find this piece of information really interesting. What's that mean? Why is there a growing number of single identifier American Indians living immediately off reservation? So this, thank you, exactly. So that's a problem, right? It's basically saying people want to be at home, they want to buy houses, and so where's the problem? It's not so much income, it's other kinds of issues. So that's the point of my talk here, is to focus us, to kind of get us over that hump, to focus on other issues. I've got two more big points I want to make, but I invite another comment. Is it Jason? I know I should know your name, yeah. Jake.
Is this American Community Survey information?
That one, yes.
So that's self-identification data?
It is, so there's all kinds of, everybody knows the problems with census data, but I still think there's a very high correlation between single identifier American Indians, or single race identifier American Indians, and tribal citizenship. Most tribes think that there's a fairly high correlation there. So yeah, it is a census issue, but I don't want to get into the details of census data. I instead want to go on and make my other two sort of big points that are in response to Dan, and then we can have a broader conversation about it. When we were doing the research for the access to credit and capital in American Indian communities for the CDFI fund report, one of the things that we heard across the board in the more than 10 convenings that we did to hear community feedback was individuals saying to us, we want to be able to buy a home at home on our land. So that gets to this point too. So it really starts to converge on this point about that increasing middle class issue, the availability of having the income flow to pay. Now that doesn't address the issue of down payment monies, which is I think another one of those challenge issues, but just in terms of having the flow of income, that's kind of an increasingly off the table issue for more Indian country borrowers. Okay, so Dan's presentation talked about access to banks, and this to me also gets into the access to credit and the credit scores set of issues. So I want to share with you a little data about banks. Now, he had a really interesting slide that shows from about 2010, we're starting to see the bank branches decline. Well, what do we know about Indian country? It's again different. The story there is more complicated. Some of you will remember this from the Native American lending study, which the CDFI fund released. You saw a picture of it in that beautiful retrospective film that Seven Sisters put together. That study that was commissioned in 94 or 5 and finally came out in 2001, these were probably the most cited bullet points from the entire study. I bet half the people in the room have used these bullet points in grant applications that they've made. And here's the stuff that we knew from the late 90s into the very early 2000s about banks and ATMs in Indian country. 14% of communities on Indian lands as of about 2000 had a financial institution in their community. Approximately half had financial institutions sort of nearby, relatively 30 miles away. Only half had an easily accessible ATM, and there were a number of Native communities where you had to travel more than 100 miles to access a bank. Well, in work that we've done that'll soon be released, we've tried to not exactly replicate that because that was a key informant interview type survey. It got a lot of responses, I think over 600 to it. But not being able to precisely replicate it, we tried to do a more scientific approach to understanding the proximity of banks. So taking FDIC bank branch data from 2013, so again, it's not quite through this 2016 or 15 time period that Dan's data looked at, and then looking at the geographic center of reservations, tried to understand where banks were and where ATMs were with reference to Indian country. So if you look at this, basically this graphic is saying you the median distance that from the geographic center of any reservation in the lower 48 to a bank branch, the median was about 8.3 miles, the mean was 12 miles, and the maximum was 88 miles. So the access to an ATM is even better, a mean of 4.24 miles, and, sorry, a median, and a mean of 6.9 and a maximum of 61.43. Actually, one of the things that I found really interesting is places like this development are one of the reasons why there's greater ATM access. In general, if you have a tribal casino, you need to have an ATM. So there's a lot more access to ATMs in Indian country, but it does feel like there's increasing access to bank branches too. Now that's notwithstanding what's happened over the last 3 years. Again, this was FDIC data from 2013. There has continued to be bank branch closure. But I think that the main story, even through the recession, is that in Indian country there's been a little greater access to banks than there even was during the 1990s. So yeah, we need to be concerned about that bank branch story, but maybe not as concerned as the rest of the world, because there's been some increases in Indian country, which focuses our attention on other things. How do banks treat people? What's going on in the lending market? So Dan mentioned the Home Mortgage Disclosure Act, which is one of the great sources of data out there. We've done some very limited evaluation of what's called HMDA data, Home Mortgage Disclosure Act data. And this takes a selection of 8 non-states that have significant Indian lands in them and tries to ask the question, for American Indians, that was the question coming over here, for American Indian borrowers, so they're either the borrower or the co-borrower, who are located on reservations land, so this is county-based data or census tract-based data, so some of it is kind of bleeds over the reservation boundary, but it's focused primarily on American Indian lands. Look at a couple of things. So basically we looked at 3 years. We looked at 2003, 2006, and 2010, trying to get pre-recession, sort of immediately prior to the recession, and a little bit post-recession, emerging from the recession. And the blue shows that whatever the condition was true in every single year, that it didn't matter what external market conditions were like, that condition was always true. So I want to focus your attention on the second map up there, had a higher loan denial rate. So American Indians who were seeking a mortgage, who were living on American Indian lands, had a higher loan denial rate in every single year, regardless of the external economy circumstances in those 9 states. They also posted a lower loan as percentage of income value. So you can already feel that American Indians are not trying to go after those enormous loans. They're trying to adjust to say, I'm not trying to borrow more than I should or more than what's really risky. I'm adjusting and I'm still getting denied. And it points out that they're requesting lower loan amounts. That's in the very first map. Again, making those adjustments to sort of lower that perception of risk to the lender, and they're still getting denied. They're applying for proportionally more home improvement loans, potentially to sort of say, behind me, here's my collateral of my house, can I simply improve my house? And they're still getting denied more frequently. So that's starting to explore what's going on in the Indian lending market. Some really interesting data that comes from the Center for Indian Country Economic Development. Dick Todd, who's actually in DC doing some presentations today around data in Indian country, worked with a couple of economists from Virginia, from several universities in Virginia. And here's where I think the Center for Indian Country Development really brings great value to Indian country. They were able to negotiate with a partner bank, the New York Federal Reserve Bank, and get some private access to Equifax or consumer credit scores. Now these scores are not broken apart by American Indian and not American Indian, but they are broken apart by specifically for the scores on reservations. And the work that was done was fascinating because they were able to look at scores specifically on reservations for all residents, scores for any census tract that straddled a reservation. So there was some land off and some land on. Those that were immediate adjacent to a reservation, so it came right up to the reservation border, and those 10 miles away from a reservation. So they're looking at a really restricted set of census tracts and saying, what's going on with consumer credit scores in those census tracts? This graph shows you that on reservation for all residents, regardless of race, that the credit scores are lower, okay, than any of those other geographies. And I find that interesting. It's not just American Indians, but it's everyone, and the physical presence of reservation land. And again, it was pointed out here, the critical piece, that there are trust land issues in that. But let's plumb that more, setting aside the trust land thing. Let's see if we can provide a little more data. This picks apart that chart and looks at it in 19 states and says what's going on with credit scores in those 19 states for people who live on reservation land. So the red bar goes up to 2012, the blue bar goes up to 2002, so you've kind of got a pre-recession and post-recession. I filled in a little bit of data from Dan's chart. Do you remember his chart where he gave you the 10 percentile of lending? Basically, he said 90% of loans were at credit scores higher than this and 10% of loans were at credit scores lower than this. Well, what was going on in 2002? That 10% percentile bar was around 595. And you can see that a lot of Indian country, their mean credit scores on reservation were still kicking in above that amount. So they should have been, in a sense, eligible borrowers, right? For many of those people living in Indian country. Again, this is not just American Indians, but it's all reservation residents. Well, you know, we had the recession, we saw that tightening, those incredible charts he showed you of the surveys, of the senior lender surveys saying, yeah, we're tightening up credit here. So we would expect some changes in this. So here's what's gone on in 2012. That the point was around 640 for the 10 percentile separating from the 90th percentile on the charts that Dan showed you. But concentrate on the red bars. We're still seeing significant portions of Indian country, so people living on American Indian lands, who have credit scores. These are mean credit scores. So again, remember, there are a lot of people even higher than the mean. Okay, the mean is just that average, right? And so there's still people who should be kind of in that range of reasonable to have lent to. I don't quite know how that mixes with some of the data that Dan presented on what was going on with blacks and Hispanics. Remember, there was a real retreat from the lower credit score lending for blacks and Hispanics post-recession. And it'd be interesting, I don't have the data to run it on what was going on with American Indians post-recession to see if there was that same retreat. But just in general, we're starting to see that there is that borrower eligibility in this range. This does draw attention, I think, though, to states like Oregon, Nevada, New Mexico, where they're never really making that boundary. So there might be helping us concentrate on where credit needs to be really increased. So we do also know that there's been activity on trying to really work with American Indians living on reservation to increase their credit scores. So, I want to back up and say one more thing about this. The other thing that's really interesting about this, there's a beautiful paper for those of you who like to read dense economics. I mean, people like me like to read dense economic papers, but I encourage you to read it too, or I'll send you a highlighted version that has yellow highlighting on the important lines. And the thing that's true here is less lending took place with the higher percentage of American Indians who lived on a reservation. So the correlates of lending that this study showed were that it was potentially pointing to discrimination. The paper says, look, we can't make that claim yet. We don't have strong enough data. But as we look about how the lending is occurring, the higher percentage of American Indians who live in this community, the less likely it is that they're getting mortgage lending, regardless of what their credit score is. So this is a very important paper to be taken away. Okay, now let's talk a little bit about CDFIs, and then I'll go on to my final point. We know, and this was one of the things that Jackie pointed out in her presentation, that CDFIs have been critical on really improving credit scores in Indian country. I just want to show that of reporting CDFIs to the CDFI fund, and not every single native CDFI reports, because not everyone gets a grant that year and not everyone's required to report that particular year. But of the reporting CDFIs, approximately 50% in every year are engaged in housing development services. That's basically training people in how to develop a house, or in how to develop a mortgage and how to pay a mortgage, and to be, figuring out how to do home ownership. And we know that a number of them, again, about 40 to 50%, are reporting credit scores to credit agencies. So they're really working with people to build their credit. And when you work with folks to build credit, this is kind of giving a spotlight initially to Four Directions Development Corporation, who's going to be speaking with you this afternoon. When you work with tribal consumers and tribal home buyers on increasing their credit, you actually see substantial credit increases. So this is looking at all the borrowers of the Four Directions Development Corporation and seeing that on average, they're really pumping up the scores of their borrowers. So quick credit conclusions here on access to credit is that banking services access has improved. American Indians try to adjust what they're borrowing and still get denied. The observation on credit among borrowers of all races points to both land issues and potentially to discrimination, and that CDFIs are working to make a difference. Happy to talk with you more about these points, but I'm getting the stop sign from Joanna because she wants us to have discussion time. So I want to make my final point, which is to really address the trust land issue, which that looms large in everybody's mind. I want to just, give a shout out to the 184 program because this shows us what's gone on with 184 lending. This is, the HUD program that helps provide guarantees to lending on trust land. It has really provided a lot of access to credit in Indian country over the years and an increasing amount of credit for lending on trust land. So this is the trust land picture. Now, the problem with that picture, and here you can see the huge amount of increase. The left-hand side is the annual investment, and the right-hand side is the cumulative investment. So you can really see the amount of capital being churned out to Indian country for mortgage lending through 184. That's impressive. I mean, we're way up to the $400 million mark. Here's the problem, and you heard this in the retrospective video at the beginning, and is that there's been a real shift to focusing on fee simple lending. And you start to see that shift in about 2004, where the amount, that incredible curve we saw of increasing lending to trust land looks flat when we compare it to increased lending through the 184 program on fee simple land. And here's the cumulative curve that really drives it home. This lending, which is a program that is structured to help provide credit and capital for home mortgages on trust land, for a variety of reasons that I know Tom Wright will be able to talk about immediately after this, has had to shift to lending onto fee simple land. So what's the take home from that? We know how to lend on trust land. We're just not doing it very much because there are other things in the system stopping us from doing it. One, there's not enough money. Two, there's a lot of preventative things at the tribal level, and there's preventative things at the lender level, and there's preventative things at the governmental level. So there's lots of barriers and challenges that stand in the way. These are some of them, bureaucratic issues that complicate things. But also, I just think lenders need a lot better information to engage with tribes around trust land lending. And that's part of the challenge on the table today. And so I'll leave you just with this, with a few things that sort of say, let's not talk about that story that's not really true, because a lot of data shows that it's a much more complicated story. Let's concentrate our attention on really figuring out how to move forward and to really figure out where the real challenges and barriers are now. Some of them are with lenders, some of them are with federal government, some of them are with tribal government, but they need to be solved in order to really get to that next really bright spot of an expansion of housing, home mortgage lending in Indian country, and of home ownership in Indian country. So I'll just end there, and we're available for questions for another 15 minutes.